In a shocking development, Canada seems to be exhausted and already going soft after fighting against Trump's tariffs for several weeks now. Ontario Premier Doug Ford seems ready to surrender in his latest interview.
But, let's work together. Let's sit down. Two greatest countries in the world.
Meanwhile, India and China aren't backing down. Both nations are rising to the challenge, launching retaliatory tariffs and imposing strict trade restrictions in response. Europe, too, is talking tough. But the big question remains: will the EU follow through with real action, or is it all just political posturing?
As Europeans, we will always promote and defend our interests and our values, and we will always stand up for Europe.
Trump's latest wave of tariffs is an all-out trade war against countries around the world. His tariffs spared no one, not even penguins. The situation is growing increasingly alarming, with many warning signs pointing toward the worst recession in U.S. history, one that could be even more devastating than the 2008 recession. Get ready, because this affects everyone, and we're breaking down everything you need to know to stay informed and prepared. Before we dive in, don't forget to hit that subscribe button to stay ahead of the curve. Let's get into it. President Donald Trump announced on April 2, 2025, that he was declaring it Liberation Day. Standing in the White House Rose Garden, he revealed a sweeping plan to impose tariffs on all imported goods. The announcement sent shockwaves through global markets, leaving investors, businesses, and world leaders scrambling to respond.
For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating.
Trump declared that every product coming into the United States would now face a 10% tariff. But that was just the beginning. Countries that he claimed were taking advantage of America would face much higher tariffs. China, for example, would be hit with a staggering 34% tariff, while European countries would face 20%, Japan 24%, Vietnam 46%, and Cambodia a crushing 49%. He insisted that these tariffs were not meant to start a trade war, but to make things fair. Holding up a chart for reporters, he pointed to what he called unfair trade practices. Other countries charge us massive tariffs while we let them take advantage of us for free, he claimed. This stops today. We are finally standing up for American workers. If companies don't want to pay the tariff, they can build their products right here in the United States. His words sent immediate shockwaves across the world. The euro surged 2.5% against the dollar in a matter of hours, marking its biggest daily rise since 2015. This is a sign that the world may be turning to Europe for fairer deals and leaving the United States behind. Global stock markets tumbled as investors feared a trade war was now inevitable. Companies that rely on imports were thrown into chaos, unsure of how they would absorb the higher costs. For example, sneaker and apparel companies like Nike are particularly vulnerable. Since much of their production is based in Vietnam and Cambodia, the 46% and 49% tariffs are hitting them hard. Shares of these companies have plunged by 15 to 30%. Retailers warn that prices for shoes, clothing, and even toys could spike sharply, affecting not only Americans but consumers around the globe. The entire world economy seemed to tremble in the wake of Trump's announcement. Trump's approval rating also suffered a hit from this development. Trump's approval fell to 43%, which is the lowest since returning to the office. But the reactions did not end there. International leaders wasted no time in reacting. The European Union condemned the move, calling it reckless and promising swift retaliation.
And we're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
European countries held emergency meetings to determine their next steps and what their own tariffs on American goods would be. China responded with sharp criticism, calling Trump's decision economic bullying. Officials in Beijing said they were considering filing a formal complaint with the World Trade Organization and preparing their own tariffs on American exports. Japan also expressed outrage, warning that relations between the two longtime allies could be strained. While countries like China and the EU prepared to strike back, Canada took a surprising turn. In recent developments, Ontario Premier Doug Ford has expressed appreciation for Canada's exemption from the new tariffs and has expressed a willingness to engage in dialogue with the White House to resolve the ongoing trade tensions between Canada and the United States. This marks a notable shift from Canada's previously firm stance, suggesting a recalibration in response to economic pressures. Initially, Canadian leaders, including Ford, adopted a resolute approach to President Donald Trump's imposition of tariffs. The Canadian government responded with retaliatory measures, imposing tariffs on $30 billion worth of U.S. goods. These actions were intended to counteract the U.S. tariffs and demonstrate Canada's unwillingness to be coerced. However, the economic impact of these tariffs has been significant. Canada's heavy reliance on trade with the U.S., with over 70% of its exports directed southward, has made it particularly vulnerable. Economists predict severe repercussions, including potential job losses reaching up to 1 million, particularly in provinces like Ontario and Quebec. The auto industry, a cornerstone of Ontario's economy, faces existential threats due to the 25% tariffs on vehicles and related components. In light of these challenges, Premier Ford has signaled a readiness to negotiate. He suggested that Canada would consider dropping its tariffs on U.S. imports if President Trump reciprocated. Ford stated, "I think the only acceptable tariff is zero," emphasizing his preference for mutual elimination of trade barriers. This soft approach is somewhat unexpected, given the earlier tough rhetoric from Canadian leaders. The initial stance was one of defiance, with measures such as banning the sale of U.S. liquor in certain provinces to demonstrate resolve. However, the tangible economic strains appear to have prompted a reassessment of this position. But the bigger issue is how all these are leading to a recession. Experts now say there is a 50% chance of a recession in 2025. This is a big jump from earlier predictions and suggests that the economy is in serious trouble. This warning is not just based on fear, but on real problems in the economy that are getting worse. One major issue is that recessions are not recognized immediately. On average, it takes 7.3 months for economists to officially confirm that a recession has started. This delay can be dangerous because people may not take action soon enough to prevent further damage. During this waiting period, companies may cut jobs, people may spend less money, and the economy may weaken even more. The National Bureau of Economic Research, NBER, does not define a recession simply by looking at GDP. Instead, they check if the entire economy is shrinking, not just one part. They look at job losses, lower spending, and other economic troubles to determine if a recession is happening. Big banks like Goldman Sachs and JP Morgan have already warned that the economy is slowing down. They believe consumer spending is falling, meaning people are buying less. Businesses are also feeling less confident about the future, making them hesitant to invest or hire more workers. Goldman Sachs has increased its prediction of a U.S. recession to 35%, showing that even financial experts are worried. All these factors suggest that a recession is either coming soon or may have already started. The growing chance of a recession, the delay in recognizing it, the official definition by NBER, and the warnings from major banks all point to the same conclusion. The economy is in trouble. For the average family, that means job insecurity, higher prices, and tough financial choices. We've seen this before, and it's never easy. The real question is whether we can still prevent a full-blown crisis or if we have already gone too far to stop it. Looking at history, the U.S. has faced 13 recessions since 1945. Some lasted only 2 months, while others dragged on for 18 months. Every recession brings economic pain, causing job losses, lower wages, and reduced private investments. It is important to understand how recessions affect different parts of the economy, such as the stock market, housing prices, rent, and tariffs. According to data, the stock market typically peaks about 8 months before a recession begins. So, if the market peak occurred in February, the recession would likely be officially declared around October. Looking at past recessions, the S&P 500 index tends to drop by an average of 30%. This means many investors lose money when the market declines. However, the stock market doesn't always perfectly reflect the state of the economy. Stocks can start falling well before a recession begins and often recover faster than the economy itself. History shows that in 85% of cases, the market returns to growth within a year, and after 3 years, stock prices consistently recover. Unlike stocks, house prices don't usually fall during recessions. In the last 6 recessions, house prices went up in 4 of them. The only big drop was during the 2008 financial crisis when home prices fell by 20%. One reason why home prices stay steady is because interest rates usually go down during a recession. This makes home loans cheaper so people can still afford to buy houses. Also, many homeowners have either paid off their mortgage or have low fixed interest rates, so they don't have to sell their homes in a panic. Even if some investors and Airbnb owners decide to sell their properties, it is unlikely that house prices will crash. Meanwhile, rent prices usually stay the same or increase during a recession. This happens because fewer people are buying homes, so more people need to rent. For example, during the Great Recession of 2007 to 2011, rents went up because there were more renters and not enough affordable housing. This could actually be an investment opportunity, so how do you take advantage of this situation? The most important thing for financial stability is to have a steady income and not stop investing when the market is down. Market ups and downs are normal, but over time, staying invested has proven to be a successful strategy for wealth growth. The biggest challenge during a recession is not just market declines, but also keeping a stable job and financial security. Those who can continue earning and investing through tough times usually come out ahead in the long run. Long-term investors who stay patient and hold on to their investments during downturns often see significant gains when the economy recovers. It is crucial to rely on unbiased financial information and be prepared for both risks and opportunities that come with a recession. Understanding these trends can help people make better financial decisions during a recession. By learning from past recessions and watching current events, investors, homeowners, and policymakers can prepare for the challenges ahead and make smart choices to protect their money and businesses. While critics have voiced strong opposition, arguing that Trump's move could plunge the global economy into a disastrous trade war, others, particularly U.S. auto workers, have embraced the tariffs with optimism. For certain sectors of the American workforce, especially those involved in manufacturing, the tariffs were viewed as a step toward leveling the playing field. U.S. auto workers, for example, saw the move as an opportunity to boost domestic production and protect their jobs from overseas competition. By raising the price of imported vehicles, the tariffs made American-made cars more attractive to consumers, which, in theory, would strengthen the industry and protect local employment. The response from the auto industry was largely positive, especially from unionized workers in the Midwest, where manufacturing jobs have been threatened by cheap imports for years. With the tariffs in place, the hope was that car manufacturers would shift more production to U.S. factories, creating additional jobs and bolstering the industry. As unions celebrated the protection of jobs, some economists even suggested that the tariffs could stimulate investment in American infrastructure and manufacturing. The potential for long-term growth in sectors like automotive production and steel manufacturing generated a sense of optimism, even amid broader concerns. If other nations imposed their own tariffs on American goods, U.S. exporters could face barriers to key markets, which could result in lost revenue and layoffs. Despite the growing concerns, President Trump remains defiant. He maintained that the tariffs would lead to enormous revenue gains for the U.S. government, which would then be used to reduce the national debt and lower taxes. In his view, the tariffs were part of a broader strategy to protect American interests and bring back American jobs. Yet, the initial economic response to the tariffs was anything but reassuring. As the U.S. faced growing uncertainty, political leaders remained sharply divided. Some Republicans hailed the tariffs as a bold, overdue move that would return economic power to American workers. Yet other Republicans, alongside many Democrats, cautioned that the move could backfire. The global economy teetered on the brink of instability as tensions escalated. Trump's Liberation Day may have started with fanfare, but could it end in financial chaos and global isolation? The world is watching, and the consequences could be historic. Let us know what you think in the comments, and don't forget to subscribe for more deep dives into the global economy. Thanks for watching, and see you in the next one.